You want to share the wealth with your kids and grandkids, but that could cost them and you. Jim Lineweaver is here to gift us with great information about gifting. Jim is a certified financial planner professional with the Lineweaver Financial Group. Welcome back to the show.
Yeah, thanks for having me.
Are we talking about the annual gifting limits?
No, that's what most people are familiar with, and that's the $14,000 per person per year that you can gift without any gift taxes or real consequences. What we're trying to talk about today is the kiddie tax, though, which a lot of people don't understand. In an aggregation, it could actually cost you more in taxes.
Okay, the kiddie tax, what is that?
Yes, well, we love having these kiddies around, but what ends up happening is that if we're not careful and you're trying to put money in the kiddie's name or kids' names, the rules changed back in 1986. And basically what the government said is that if you're trying to put a lot of money in their name to shelter maybe some taxation on the interest and stuff, well, if it goes over a certain level, we're going to penalize you. And what that income level is $2,100. So basically what it means is the first $1,050 is really going to be basically tax-free. The next $1,050 that would be coming in any one given year from interest income, dividends, capital gains in that kid's account, that second $1,050 is going to be taxed at the child's rate. Maybe they're not working, so potentially could still be tax-free or very low.
Right.
And then anything over the $2,100 is going to come back at the parent's rate. And that's where a lot of people don't realize some of the tax ramifications.
Okay, so if a child keeps their investment income at $2,100 or below, then they avoid paying taxes.
Basically, yes. Depending, but if they have a little bit of an earned income or something, that second $1,050 could get hit with a little bit of tax. But for all intents and purposes, you're exactly right.
Okay, so if there's more than one child in the family, though, I mean, you're talking about the kiddie, it could be kiddies.
Right.
So how does that affect the tax rates and the investments?
Well, a lot of people don't realize it gets aggregated. Okay, so like myself, I have 3 kids, and we actually have an example for your viewers. But if you add up all these kids' accounts and you add up the interest that's accumulating in all of them at the end of the year, it could be pushing you into another bracket.
Okay, so you've got an example, you said.
I do. So let's say the parents are making about $230,000 of taxable income in the household. You have a child named Molly, and their account earns $2,700 for the year. So that's over the $2,100 threshold, so that's $600. So normally you wouldn't think it's too bad, but you also have Brent as a son, and that child has $3,200 of interest income, again over the $2,100. So now we have $1,100 from him. So we're looking at $1,700 of additional taxable income. That, guess what? It's jumping all the way up to the parents' bracket, and it's not at the, as marginal as the lower ones.
It just
it's
slots
come
in there
right
way
at the top.
up high.
It's going over the 230. So it's adding up to quite a bit.
So how does that actually impact the parents' taxes then?
Well, what's going to happen is that the first basically $1,450 is going to be taxed at a 28% bracket, and the remaining $250 is going to be taxed at a 33% bracket. So their taxes go up, and a lot of people miss this, and it's something that gets added at a very high rate.
Wow, you got to have some proper planning with this, right?
You do, yes.
All right. Don't kid yourself. With a kiddie tax, your financial gifts could become costly. For help in gifting without regret, give Jim a call. His number's next.
For more information, call the Lineweaver Financial Group at 1-888-313-4009 or click to www.lineweaver.net. Next, service and support.